Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. My name is Bryce, and as always, I am joined by my equity buddy Ren for the last episode of our week with Roger. How are you going?
I thought you were going to say for the last time I was joining you. Roger's been so good this week that I'm getting booted and he's replacing me. But look, Bryce, I am very excited for this episode. We have Roger Montgomery, founder and CIO of Montgomery Investment Management, joining us again. Roger, thanks for joining us.
Great to be with you guys.
Well, I should say thanks for sticking around and bearing with us.
It's been a long week. Yeah. People don't realise I've just been sitting here the entire week.
Yeah. He's got a sleeping bag in the corner.
Haven't changed.
But look, Roger, I'm very excited for this episode because Bryce turned 30 about a month ago now, and he hasn't let us forget it. We've done podcast episodes, we've done AusBiz episodes, all centred around his 30th birthday. And one question we've been asking is, what's in celebration of Bryce's 30th, what's a stock you would hold for 30 years?
Yep.
Now, before we started filming, we said, do you have a stock that you could talk to? And you actually said you had 5. So we've got to start there.
Okay.
You've got 30-year time horizon. What are the 5?
I would have no hesitation in telling people on your program to put this portfolio together and forget about it for 30 years. It's going to go up and down in the interim, but I think in 30 years' time, every one of these companies will be more valuable than they are today.
Let's start at the top.
So let's help you out, mate.
Yeah.
So a stock that you already own.
Do you have a pen? I need to write this down.
So for the just unbelievably, the amazing culture in the organisation for deal making, and just the consistency with which they just find amazing deals to invest in and then sell those deals to customers. Macquarie Bank.
Love it.
Great.
I know you do.
Yes.
So that's the first one. The second one would be CSL.
Yeah. Yep.
CSL is a mining company.
That's the first time I've heard it described as that.
It's a blood mining company.
We're talking, okay.
They mine blood and they find new products to make out of the plasma that they extract from people's blood.
I like the way you conceptualise it. Yeah.
And we think that that there is a reliably growing demand for the products that they're developing, and they've got a pipeline of potentially very, very valuable products. At the same time, we know how important viruses are to our community, and their ability to develop vaccines for viruses, are second to none, and to manufacture those vaccines. And so we see a whole host of reasons why that's a business that you just want to own long term. I'm also reminded of a fellow that one of my staff met, who they were playing a golf game together, and this particular individual said that he was taking a lot of holidays. So my colleague asked the question, what do you do for a living if you're on holidays? You seem to be very successful. What do you do? And he said, I manage a portfolio. I manage a stock portfolio. And then my colleague asked him, what's your philosophy and what's your process and where do you sit in the value versus growth camp? And he said, no, I just have one stock. I just years and years ago I put $1 million into CSL. It's now worth 200 million.
Wow.
And that's my portfolio. And I just manage that, and that's my ATM machine.
Whoa.
So it's a company that's grown phenomenally, and I think its future could be as bright as its past.
Wow.
So that's the second stock. Third stock, really another sort of healthcare business or a medical device business, Cochlear.
Right.
I think Cochlear again. Its returns to investors, both CSL and Cochlear, its returns to investors in the recent period hasn't been good as further back. But that's because there's so much other exciting stuff going on in the stock market. I don't think the market's attention has really been focused on the capability of that business. And so I believe, again, that's another business that's going to go extremely well over the next 30 years. Demand will continue to rise, and they're at the forefront of that technology. They will always suffer when one of their competitors develops the next U-Butte hearing aid device. that cochlear implant, but it's really important to note that then cochlear advances again and beats them. So they lose a bit of market share sometimes, and then they gain it back. And so that cycle will just continue over 30 years. I'm sure you'll see that happen again. And the other two businesses, you might not have thought about them this way, but I think they're two of the best run businesses listed in Australia. One of them is Reece Plumbing.
Okay.
Reece is an amazingly run business. Other than their most recent acquisition, they haven't raised $1 in a decade or more, and their return on equity has been rising. They are an incredibly run business, a great culture, great brand. Really well loved and liked from the consumer side, incredibly well run from the economic side of that business, and they will continue to do very well, particularly with their recent acquisition. And then the last one is ARB, the four-wheel drive, aftermarket four-wheel drive parts and accessories business. ARB is another incredibly well-run business. Roger Brown's been running that business for a very long time. He and the team have done an incredible job over the last 20 years or more, and I think they'll continue to do very, very well. Their reputation is second to none. Their customers love their product. There was a fake overseas. There are fake ARB products where they actually put the ARB sticker on a fake product because they want it to be ARB.
Wow.
I mean, that is, analysts like to say, "Oh, that's a problem." I think it's a compliment, because people will pay more for the real ARB product, and they will always be at the forefront of developing new products. And this whole electric vehicle revolution, that feeds into ARB, because the more new cars that are developed with different shapes and whether they're EV or internal combustion engines, it doesn't matter. People will want to go four-wheel driving, they want to go off-road, they want to escape city life, or we'll continue to have mining. We'll need to mine lithium. We need four-wheel drives, and they need bull bars. And so ARB is going to continue. Their products are going to continue to be in demand. And I'm telling you to own these for 30 years, primarily because they are so well run, and they are so disciplined about their capital allocation. Their ability to retain profits and generate high rates of return on equity is excellent, and they're very disciplined about doing that.
Yeah. I've got to ask, and I'm sure many of the Equity Mates community would be as well, is there a reason there was no mention of the big tech?
Look, I presumed you wanted Australian stocks.
I'm not complaining at all. I'm going to go, and just for the sake of the exercise, I'm going to do the portfolio. I already own these stocks, but I'll just go and buy some more. It's no problem. I have no problem owning them. I'll call you when I'm 60.
Yeah, well, I know my kids will be very grateful that I bought the stocks for them when I'm gone. In terms of global stocks, sure, there's the obviously Microsofts and Apples and Amazons of the world. What will disrupt those businesses, and the reason I didn't mention them for 30 years, I think they are, and I mentioned in a previous episode, they are businesses the likes of which we've never seen before. Their economics are second to none. The one thing that could stop them is if they got too big, antitrust. They could be forced to break up. And I just don't think Reece and ARB and CSL will be broken up, whereas those businesses could be broken up, and that could disrupt the story. So it's why I didn't mention them. But equally, there are businesses like PayPal, Louis Vuitton, Autodesk, Estee Lauder. They are amazing businesses that I would be more than happy to own for the long term. That are overseas stocks. Yeah.
This is a question that I have, and full disclosure, I put Alphabet as my 30-year stock, so maybe I'm being a little bit defensive here, but I want to ask the question because when I was talking about it, obviously the antitrust story is really the big story in terms of what could slow them down. But also, you can't really see a way to break up some of these companies that disrupts the unit economics and the growth story that they have. You could separate YouTube and Google search, but that search ad revenue is going to keep just generating free cash flow on free cash flow. How do you think about, is antitrust as much of a risk as some people talk about it?
Their power comes from their monopoly. The power of all of Warren Buffett's businesses comes from their monopoly. Their ability to charge what they want. The most valuable competitive advantage is the ability to charge a higher price without a detrimental impact on unit sales volume. And that's what you want. You want a board sitting around the table and the only decision they have to make every year is how much should we raise the price by? And know that it's not going to have an impact on how much they sell. Or you want a business that when they charge more, people buy more because it's perceived to be better quality because it costs more. Right? That's Tiffany's, for example. Notwithstanding they made some bad acquisitions. So you know, in the Poland Capital Global Growth Fund, which we introduced to Australian investors, the businesses that are owned in that portfolio are unimpeachable quality. They generate high rates of return on incremental capital, and they have the ability to raise their prices. But to answer your question, the question is about the company's continued ability to leverage their monopoly. So if you can't break them up, you perhaps can control how much they can charge.
Yeah,
right?
that would be a different,
And so the question is about leveraging the power of monopoly. That's what gives them their great economic strength, but that's also the potential contingent liability because that's where government comes in and says, hey, you're just making too much money, you're charging people too much for this, it can't go on forever.
Yeah, that's interesting. Then they become basically a utility with regulated prices.
Correct.
And, hadn't thought of it like that.
Yeah.
That's why we get you on, Roger. So we do have a little bit of time, and unless Bryce wants to keep asking about what other stocks
I'm
you'd
happy
put in
with
the
my
portfolio.
30-year portfolio.
We'd love to just finish on this theme of the next 30 years. What are some of the, I guess, the trends or you know, I guess the more general things that you expect to play out in that time frame? We're not asking you to pick the future here, but I guess what are you watching as we...
I think a really obvious one is cloud computing.
Nice.
You know, I think at an enterprise level, cloud has penetrated about 22% of its potential market. Now that's where smartphones were 12 years ago. It's where laptops were maybe 18 or 20 years ago. There's huge growth left in the cloud. And investors today are really thinking of these cloud and data center operators as COVID winners, because obviously during COVID lockdown, people were streaming more, streaming music, streaming movies, working from home, you know, Microsoft Teams, Zoom, all of that sort of thing. But these are structural winners. There's a structural theme that's going to go for decades here, and I think that's a really important one. The other one that I think is really important to watch is actually electric vehicles. That's happening, whether we like it or not. And it might not be EVs, it could be hydrogen, but a transformation of the auto industry is underway. And you saw earlier this year with Volkswagen, they had their Power Day webinar that was a couple of hours long. People who haven't seen it should Google it and just see what Volkswagen's planning. They're going to spend, pardon me, something like 22 billion euro developing out a network of fast charging stations, developing 24 models with a modular battery system and battery recycling. You know, that's a big story. Now, you might not make money picking the winner in the electric vehicle space, but you can make money picking the loser, right? So when the car was invented, you knew the blacksmiths were going to lose, right? You couldn't pick the winning car manufacturers. They've all gone broke at various times in their lives or been taken over by governments or saved by private equity. But you knew the blacksmith was on the way out, although people at the time, some of them didn't. You know, what the world needed, or what a lot of people thought the world needed when the car was first invented, was faster horses, not the car. They didn't think the car was going to be the thing. But if you had the foresight, you'd pick the losers. So you might want to ask the question, I don't want to give too much away here, but you might want to ask the question, over the next 30 years, who loses from the advent of electric vehicles? And there are sectors that are going to benefit. There's going to be massive increases in demand for electricity. You know, if all of the world's cars today switch to electricity, the infrastructure, the electric infrastructure in most countries wouldn't cope. You know, so what are we going to do about that? We know the oil industry, there'll be probably oil left in the ground that we will never extract. You know, there wasn't that long ago that we were talking about oil going to an infinite price when the last barrel is pulled out of the ground because it's going to be so valuable. Well, in actual fact, I think the opposite is true. I think new technology will replace or supersede oil, and oil will be left in the ground. You know, there's a famous quote from an Arabian oil minister from the 1970s. He said, "The Stone Age didn't end for a lack of stones." Better technology came along, the Bronze Age, and replaced the Stone Age. And so that's what we're seeing happen now. So that's another thing that I think investors should be thinking about, or another trend. And then the final one is automation and the disruption to jobs. It's going to improve companies' margins. So ask yourself, who benefits from automation? There's companies like Altium in Australia. They make software that help people design printed circuit boards. That kind of business is going to benefit. The more electronic devices that are out there, the more PCBs that are out there, the more that software is going to need to be used. So there's a lot of themes that I've talked about. There's lots of opportunity in those themes. And then if we bring it back closer to 30 years, you've got the reopening trade as well. The vaccine rollout, who's going to benefit? Think about Carnival Cruises, right? I own some stock personally in Carnival. And the reason I bought that, it fell from $80 to about, I think it got down as low as $7 or $9. And I think I started buying it at around $11. It's been up to $34 recently, and it's in the 20s somewhere now. But here's the interesting thing about that. I was told a story that one of the big cruise companies sent an email out to all of their customers whose cruises had been cancelled. You can imagine how many hundreds of thousands of customers there are. By the way, 80% of cruising passengers are from the United States.
Wow.
Right? So it's about 80%. It's a lot. Anyway, so this is generally speaking, and I'll wrap this up really quickly. But they sent out an email to their customers, and they said, okay, we can give you your money back, which tells you something. They've got the money to pay. They've got the cash. They've raised a lot of money to survive the COVID lockdowns. So that's a good thing. And they gave them this option: have your money back, or we'll give you a $200 credit for a future cruise. And we don't know when that's going to be, but if you'd like to cruise with us in the future, keep your money with us and we'll give you a $200 onboard credit. More than 95% of passengers took the credit.
Wow.
That will bounce back almost instantaneously. As soon as people can cruise, they will cruise again. Guaranteed. And so people are underestimating, because you asked that question earlier, when? It might have been a previous episode. You asked, when are we going to reopen? When is it going to happen? I think we were talking about IDP. When is that going to happen? I don't know when it's going to happen, but if you wait until it happens, it's too late. Those stocks could rise 40 or 50% in a few days when that happens.
Wow.
Well, Roger, we could talk for another hour, but unfortunately our time is up. We like your prediction about Carnival Cruise and cruises reopening. Maybe we'll have to do this again on a cruise at some point.
That'd be great, wouldn't it? Very happy to sit for 1 week in this chair on a cruise.
But look, until then, we want to say a massive thank you for joining us.
It's a pleasure.
If people want to find out more about you, they should head to Montgomery Investment Management's website.
Yep, so if they're interested in our funds and seeing what funds we've got, it's montinvest.com.
Great.
And if they're interested in looking at our blog, and we post 1 or 2 blogs a day, it's rogermontgomery.com.
And we'll give one last plug for your book, Value.able. Check it out. It's a good one.
Thank you.
Good luck finding it, though.
Good luck finding it. It's very rare.
Unsigned. But Roger, a big thank you. And we hope that you were able to get something out of that whole week with Roger. Plenty that we covered, and very much looking forward to having you back.
Looking forward to it too, guys. Thanks for having me.
We'll see you guys next week.
Equity Mates, from our mates at Spaceship. Investing made easy.